The most important takeaway from the budget, in fact, was not on the headline number, but actually on the composition of the capex. The finance minister clearly put down a fiscal deficit target of 4.3%. From the banking and NBFC sector, there was also a lot of expectation of government doing things to boost the credit growth. They're in fact rewarding companies that have a track record of good execution, balance sheet discipline, and a diversified order. A sharp fall on the budget day, a bounce back from the 200-day moving average, and a rally after the US trade deal was announced. There's a lot that's happening behind the scenes in the market, and it is not at all random. The Union Budget 2026 has coincided with two critical events. One is the India-Europe Free Trade Agreement that happened before the budget, and second is the tariff reduction for India that was announced by Donald Trump after the budget. There's been a lot of ups and downs, and it has coincided with the volatile global cues. In our last video, we talked about the spectacular rally in the precious metals, and after that you've seen silver prices actually correcting more than 30%. This coincided with a more hawkish Fed stance that people are expecting. So there was a lot of pressure on the metal prices, there was global profit taking, and a visibility on the earnings strength in India. And while the recent market reaction after the US deal announcement tells us that the risk on sentiment has started in India, in fact, there is still underlying pressure about the global cues. Investors seem to be focused on near-term growth risk instead of medium-term benefits. You can see positive signs coming out from the Indian economy as well as on the global front. Markets right now are not focused on celebration, they focused on stability. As a result, what you've seen is that the reaction to both the budget as well as the US as well as Europe free trade deals have been more analytical instead of emotional. The implications of the announcements in the budget as well as the free trade deal seems to be gradually building up instead of having an immediate reaction. In this video, we'll talk about what are the key announcements that happened in the budget, how that impacts some of the critical sectors in India, and how that will help you position your portfolios around it. We'll also talk about how the India-US tariff reduction as well as India-Europe trade deals are going to provide us opportunities in this market, and what are the sectors and areas where you should be focusing on investors. So stay tuned. So after the budget, we saw big correction happening on the headline indices and a lot of negative sentiment being built in. I think what investors were expecting were a lot of positive growth triggers on the announcement day, but in fact, the growth trigger came after it with the tariff reduction. The most important takeaway from the budget, in fact, was not on the headline number, but actually on the composition of the capex. So capex, manufacturing, capital goods remain one of the strong areas where the government is focusing on. But instead of just government spending, the focus has now shifted on execution and how the PSUs and these large companies are going to execute on the budgets given to them by the government. We saw that the total infrastructure spend increased by 10 to 12%, which was actually as per expected. And in fact, it signals a recovery from a year where the capex undershot the estimates. The railway capex is up 11% with focus on freight corridors, track doubling, and the road capex is up 8% after being relatively flat for 2 years. In contrast, the focus on urban infrastructure, water, metro, and affordable housing has been lesser than expected, which tells us that this is a much more targeted approach to capex instead of a blanket stimulus. What's equally important is what the budget is trying to avoid. The finance minister clearly put down a fiscal deficit target of 4.3%, signaling a clear consolidation path and fiscal prudence. While various pockets in the market were expecting some growth announcements, something to boost the markets, the government stuck with the discipline path. But what mature investors and long-term investors understand is fiscal prudence in such a volatile global environment is much more important than the headline announcements. Another important announcement that came out from the budget was on the bond market. The government continues to push for deeper corporate bond market and single bond issuances. With the government spending remaining relatively flat year on year and the focus shifting towards asset monetization, the system is actually moving away from the bank-led funding of long gestation projects, which is in fact positive for the banks as it removes the concentration risk. For the equity market, there are a lot of positives coming from these bond market announcements. So while large corporates now have access to infrastructure projects through bond issuances, banks can now lend to high ROE segments like retail, SME, and working capital finance. So this will in fact improve capital efficiency across the system and support higher valuation multiples over time. From the banking and NBFC sector, there was also a lot of expectation of government doing things to boost the credit growth. The credit growth in the economy is still in the low to middle teen numbers, but the composition seems to be improving, with infrastructure spending being supported by infrastructure investment trusts as well as asset monetization. The infrastructure heavy spending is being supported by the bond market, the infrastructure investment trusts. The focus is on asset monetization instead of balance sheet exposure, and this in fact supports the risk return ratio of lenders. So the well capitalized banks will benefit from lending to retail and SMEs without increasing their stressed assets a lot. So the well financed banks will benefit from the steady increase in retail and corporate lending without stressing their balance sheets too much. And select NBFCs, which in fact focus on infrastructure, will find better matches in that segment. What it means is that the budget is focusing on steady compounding instead of just balance sheet driven growth. Even on capital good and industrial front, the budget focuses on earning visibility instead of triggering an acceleration. Railway, defense, power and industrial automation already have huge order books lined up. And what this budget has done is, instead of giving an explosive growth on the capex pipeline, and what matters right now when order books already have multi-year pipelines is that execution by these defense, railways, power and industrial companies instead of just getting increased government spending. The absence of infra spending and urban push means that not all construction companies will benefit equally. And in fact, in such an environment where you don't have a blanket growth in spending, they're in fact rewarding companies that have a track record of good execution, balance sheet discipline and a diversified order book. And at this juncture where, in the past few years you've received a lot of government capex, execution in fact becomes the most critical thing. So the cycle seems to be turning in favor of the industrials. We talked about defense, railways, capital goods, power, industrials, where there are a lot of announcements that came out in the budget and where execution has become extremely critical for us to find winners. There were also a couple of themes which corrected quite a lot on the budget day. So on the day of the budget, we saw very, very sharp corrections in the precious metal prices and in the metal segment as a whole. But that was not related to the domestic policy at all. Just before the budget, we saw an announcement of Donald Trump's support to a new US Fed governor who might be hawkish in his stance. What that means is that the dollar could strengthen, and that would in fact weaken some of the metal rally that has been happening. Gold and silver, you have to remember, seems to be a cushion against a weak dollar and a falling interest rate regime. As the US Fed governor seems to be hawkish, these prices have quickly corrected very deeply to account for that. While some were expecting some announcements in the budget to boost the metal as well as precious metal segment, we did not find much about that segment in this budget. So while domestic capex will support volumes in this segment, the price of these commodities in fact will be determined by the global demand, and the markets use this trigger to de-risk their exposure to these highly inflated assets. There was another key announcement after which the market went haywire on the budget day. The STT on the future segment was hiked by 150%, and that announcement led to an immediate correction across the market. Obviously, stocks like BSE, Angel One, Grow, which have exposure to the derivative market, saw correction, but they took down the broader market along with it. This was primarily led by sentiment. I think a lot of participants in the market were in fact expecting cutting down of capital gain taxes and support to the capital markets, because the Indian markets have underperformed. FIIs have been selling for a very long time, but the budget in fact did something counterintuitive, which is increasing the tax on derivative transactions. Now, what is the impact that you could see from these derivative transactions? As a retail trader, probably it does not matter to you that much. STT right now for a normal trader is a very small portion of your trading value. If you're going to buy something today and sell it tomorrow, you're trying to capture a much larger spread, right? Or even if you're doing an intraday trading for over an hour, you're trying to capture a larger spread, and the STT probably doesn't matter too much to you. But think of these large high frequency traders like Jane Street and all the foreign players and HFT players who play in the market. These players trade very, very frequently. So they might be trading thousands of times during a particular day in an instrument, and with every trade they're trying to capture a very small spread of 0.05% or something like that. So with this increase in transaction cost per trade, their profit margins will go down, which will mean that the derivative volumes in India, which means that the volume that you see in the future and option segment, which have been very high due to speculation by HFTs and retail traders, might go down as one party becomes less profitable. And that is what led to correction in these exchange as well as broking players. And in fact, you're seeing that signal coming out. And in fact, the signal is very clear for these capital market players. You can see companies like Grow diversifying to wealth management, Angel Win also looking at multiple venues, Zerodha also doing multiple things like the Rain Matter initiative to diversify their revenue as the derivative volumes, which are a large portion of their aggregate revenue, come under pressure. From the equity market perspective, it is in fact positive, right? As derivative volumes go down, the betting activity will in fact go down, speculation will go down, and people might invest more in longer term opportunities, and that will deepen the Indian markets. And from the market structure perspective, it just reduces speculative activity and it actually discourages excessive churn that very active strategy seems to be having. Now, before we go and talk about what stocks and sectors to focus on post-budget, let's talk about two equally important things that happened alongside the budget. One was the India-Europe trade deal and one was the India-US trade deal. If you actually look deeply into it, these two announcements are much more consequential than the budget itself. India now has trading frameworks with most of its major trading partners, which brings in more certainty to the global supply chain. This could make exports from India attractive, but that will happen more in the medium term. But in the short term, you will see boost in FDI in India. Manufacturing, electronics, capital goods and services become much more attractive for the Indian geography as India becomes a credible diversification geography for foreign players. So with China plus one as a critical theme in play, our manufacturing, industrial services will again become an attractive avenue for global players. And while we were uncompetitive compared to some of our neighboring countries, now this trade deal has made Indian manufacturing again much more competitive. So let's talk about what are the sectors that you can focus on after the budget and all these trade deals. From the budget perspective, it's very clear that capital goods, industrials, infrastructure, power, these are some of the key beneficiaries because they have multi-year order books set. Plus, they're not that linked to global events and their execution metrics seems to be improving and becoming a focus area from the policymakers itself. On the financial front also, you might see interesting movement. As we saw that credit growth seems to be growing in the mid-teen levels and their balance sheet seems to be improving as infrastructure spending is shifted towards the capital market. From the US and Europe trade deal perspective, manufacturing sectors that are aligned to those two geographies will gain. Electronic manufacturing, industrials, they will benefit from the supply chain diversification and the exports will grow in the long term, but the immediate impact would be the FDI that could come into these segments. We saw a key announcement on the data center front where a tax holiday has been announced for foreign players setting data centers in India. And in technology, cloud, data and AI, you would see growth primarily driven by enterprise adoption, and the budget announcements also have been supportive. In contrast, what you've seen is that the segments like metal have been under pressure due to the global dynamics. This different cycle playing out in the East with China and Japan, and something different that's happening in the West. Until unless we get a very clear picture of global manufacturing recovery, the metal prices could be volatile and playing out with the supply side constraints and seeing an impact of fear playing out in the markets. So while there should be a lot of domestic demand for metals, the commodity prices will remain under pressure due to the global prices, and you have to be careful there. Now there's something even more important in the budget and these trade deals that's going on, which is the earnings cycle. You've seen this earnings cycle also be at par with the previous few earnings cycles, with some companies coming up with spectacular numbers and while others who have seen some downgrades as well. The signal right now, if you look at the budget and and what's happening around you in the industry is very clear. We have to focus on resilience and execution instead of short-term excitement. As investors, the focus has to be on earning visibility, execution, and diversified balance sheets. And with these higher transaction costs and limited global liquidity, patience and selectivity matters more than anything else. So this market as well as this budget was not about chasing narratives. In this market, you have to find those sweet spots where policy direction, cash flows, and execution converge at the same time. And it's a selective market, and having that prudence to find those selective opportunities matters more than anything else. So that was our quick overview on all that happened with the budget and with these trade deals coming in. There's a lot of exciting investment opportunities, and we are fully allocated in trying to capitalize from what's happening around in the market. What do you think would be the impact of all these events that have happened one after the other? Do let us know in the comments below, and do let us know what you would like us to post about next. We'll see you soon in the next video. Until then, happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.